Kate Rooney joins us with that story. Such an interesting dynamic playing out here because they have been some of the highest valued, unprofitable, but higher rates actually help their core business, the money they hold.
There's sort of two sides of this. Rates are hitting valuations, but at the same time in the quarter we saw rates really help Robinhood, and they were a meaningful boost to Robinhood's results and are set to play a bigger role going forward, especially as its core business and core trading business slows down. Net interest income jumped 73% from the prior quarter. Executives called out rate hikes as a driver of that revenue beat. It made up more than a third of income and was one factor that helped shrink some of the losses at Robinhood. The company was profitable on an adjusted EBITDA basis. Robinhood does expect net interest income to jump by $25 million or so in the current quarter. And it's got about $17 billion in interest-bearing assets on that platform. It may even be in a better position than some of its fintech peers. Yes, earns interest on cash accounts. That's about $3 billion. But it's getting the bulk of that yield from securities lending. It also is raising the interest rate on its sweep accounts to 3.75%. These higher rates are now becoming a way for fintechs to really compete for customers. We heard that from SoFi this week, too. It saw a similar rate-related boost and a jump in customer accounts thanks to those higher rates. Executives are welcoming the help from higher rates as it helps offset some of that trading slowdown. But, of course, on the flip side, as I mentioned, those rates have hit markets and trading volume as well as some of the valuations here for a lot of the money-losing stocks like Robinhood. A bit of a catch-22 there. The big theme this year for fintechs, we've got some names reporting after the bell. It's all about cost discipline and reining in spending. Robinhood stock did get a boost after it lowered its outlook for operating expenses and stock-based compensation.
The irony of this is not lost on me. These companies, these disruptive fintechs are being rewarded not for being disruptive, but for essentially holding cash, being valued kind of like a bank or what a bank would do, making money off the net interest income. So break that down for us. I know you mentioned that Anthony Noto interview at the beginning of this week. He said that he actually was pulling in a lot of those big bank customers. It's interesting that they're not doing anything. The big banks, I guess they don't have to because traditionally it's been really sticky. It's hard for people to change accounts, even if they're getting 1 basis point on their savings account. Do you think that that's shifting, though, in this environment? There's more fintechs than ever, of course.
Yeah, it's not clear how much of a threat the fintechs are to banks. If they were, you might see Chase, move up its interest rate or do this as more of a loss leader, which is what the fintechs do. A lot of them will raise the interest rate knowing that they're going to lose money in the near term, but that it will attract customers. The other side of this, too, is that a sticky customer? The person who's willing to leave their traditional bank for a higher interest rate, is that the person who's going to get a home loan or refinance their student loan on your platform? So the question is, are these going to be sticky accounts? On the SoFi side, they actually get better economics because technically they are a bank. So a lot of these fintechs don't have access to the same rate boost as a SoFi. Robinhood has the securities lending side. So some of these just partner with banks. They're not going to be in as great of a position to benefit from this rate hike.
Right, which kind of begs the question, how do you value them, right, as traditional finance or as technology companies? As you said, though, they're all trying to cut costs, which kind of fits into that question also. We talk about the big tech giants freezing or slowing hiring, but they're actually cutting jobs. Robinhood, Stripe this morning. How does that help their balance sheets?
Well, Robinhood was 23% layoffs, and they did this about 6 months ago. You had Stripe this morning. The big thing is stock-based compensation. So there's a lot of dilution in these startups that went public that gave a lot of equity to either early employees or just the overall employee base. So that's a way to lower expenses. And that's a big operating expense line item. And so while it's a tough thing for employees in the near term, and you can say what you want about what it means for the economy, in terms of what it means for the stocks, Wall Street really likes to see this type of discipline and see these layoffs happening, especially in the public names, although Robinhood said, we've done all the cost cutting. We're kind of at the ceiling here.
Okay, well, Kate Rooney, thanks for breaking it all down for us. Looking forward to those earnings.